Takes us to our talk of the tape. Where best to position for the next bump in stocks? If the bulls, in fact, are right and another one is upon us. Let's ask Cameron Dawson, Chief Investment Officer for NewEdge Wealth, back with me at Post 9. It's good to see you again.
Good to see you.
We're going to have another leg higher? I mean, what's your assessment here? I said on halftime today we got through the gauntlet this week of NVIDIA after everything else, and, well, we're on the other side of that, and things look pretty good.
Yeah, I think it's respect the momentum and respect the trend. Momentum is certainly to the upside. Trend is certainly to the upside. That doesn't mean that we should be complacent and blindly chase everything. So I think that we're encouraged by the momentum, but we also want to remain very vigilant about things like positioning and sentiment and valuations, which are stretched. The thing about those three items is that they're not good timing tools. They can persist, which just means the momentum gives you the lift in the near term, and over the medium term, watch those three things.
It's so tricky, I think, at some points, because you look at everything you said, and you're like, well, these stocks continue to go up almost unabated. Look at NVIDIA. If I own the stock, should I trim the stock? Should I take my position down? But wait a minute, it keeps going up, and I don't want to miss it. It speaks very much to what Tony Pasquarello at Goldman has been saying, and it sounds like it melds with your point of view. He's like, okay, the dynamics in the game remain inherently friendly for risk, right? I think we agree with that.
Yep.
With that said, the profile of tactical risk reward has changed. It's like sentiment measures are elevated. The trading community is already long. The momentum factor is stretched. So I've got no problem if you want to simplify, your exposure to the best parts of the market. But I also wouldn't take my eye off the ball of the horses in this race. So how do you navigate all that?
I think that the way we interpret all of these things being stretched, positioning and sentiment and valuation, is that they add to downside risk if we get a catalyst. And the catalyst likely is an earnings bump, which just means that as long as earnings are surprising to the upside and we see a lift in estimates, then those things aren't as much of an issue. If earnings revisions start to move materially lower, then the valuation, the sentiment, the crowding and positioning is what would really cause you to see a bigger unwind.
Do you advise staying with the mega cap trade? Because, this idea that the market's going to broaden, and broadening, we have to be careful. It's beyond the small caps. I don't know if the Russell is necessarily the great litmus test for the broadening. I mean, if you look at industrials and some other areas, those charts look great. There's like 50% of industrials are within 5% of their new all-time highs. So it's not like those stocks have not done anything.
Yeah, and we're also seeing a rebound in PMIs, which is typically good for the industrial stocks as it starts to happen. We see good charts within healthcare as well. And I think it speaks to the pickiness within adding new positions. So you can let your winners ride, let the momentum take you within tech, acknowledging that it's crowded and expensive. However, when looking for new positions, looking in those areas that are earlier in their recoveries, and that's one area like healthcare where we're finding good charts to buy.
That's another debate, though. You said expensive. I mean, are those stocks really expensive? This great debate over NVIDIA's valuation, is it really expensive? I had a conversation earlier this week with Stacey Rascon. Bernstein knows that company better than anybody. Says, not misnomer, it's actually cheap.
Yeah.
And it's cheap relative to a lot of these other names, even though the stock price has elevated as much as it has based on its earnings and guidance. It's not expensive.
What is valuation when your earnings estimates go up by 4x? Earnings were $6.
Meaningless? I don't know.
I actually think it's an irrelevant discussion when earnings are going up so much because it's a moving target. When valuation will matter is when there's a question about the sustainability of earnings. So because we've seen earnings estimates go up to $24 a share for 2025, fiscal year 25 earnings, the bigger question is that if you start to see those estimates get cut, that's when valuation becomes a relevant deciding factor. But today, it's just simply less relevant.
What about rate cuts? How relevant, to use your word, are they today?
Well, they certainly haven't been to start this year. You've gone from pricing in 6.5 rate cuts in January to 3.3 rate cuts today, and yet valuations have continued to expand and yields have continued to go up. We do wonder if you get to a threshold where yields will matter, where yields will really start to pinch to say, do I want to pay 21 times for the S&P 500? As of right now, it hasn't mattered because it's been an earnings story, which we get back to the point of as long as earnings estimates are going up, valuations will be mostly tolerable, at least in the short term. It's as soon as those estimates go down that you could see an unwind in valuations.